Hello everybody, and welcome to this month's Grow Your Law Firm webinar, More Profit Equals More Cash, but How? My name is Matt Sleater. I'm the lawyer's accountant, working with legal firms all over Australia in relation to helping them drive improvements in profitability and cash flow, as well as helping them out with all of their other accounting and compliance needs. So today's webinar is going to be the first webinar of a series of three. The next webinar will be focused on how to drive improved cash flow in your firm, and then the third webinar will be about how you go about driving more revenue into your business. So you can sign up for those at financiallywellorganised.com. So please go and do so if you'd like. I'm also the author of The Revenue Revolution for Law Firms, which is also available on financiallywellorganised.com. This book basically outlines the financial strategies that you need to be focusing on and implementing in your practice to drive sustainable revenue growth and profitability growth and improving your cash flows. So at FWA Chartered Accountants, we focus on a whole range of different things with our clients, but today we're going to be focusing on looking at your business plan, and we're going to be focusing primarily on what those strategies are that you need to implement in your firm to improve your profitability. So just before I get started, I'd just like to get a bit of a feel for who's listening in today. So if you just quickly answer the poll, just to let me know if you've attended a Grow Your Law Firm webinar before. So we'll just run through these pretty quickly. So thanks for that. So we've got about half and half. So for those of you who are rejoining again today, thank you for your continued support and attendance, and hopefully you continue to get some good value out of these webinars. For our new participants today, welcome. I try to run these webinars once a month. Sometimes a few other things get in the way, but you'll be receiving invitations for those in the future. What best describes your firm? Are you a sole practitioner, 2 to 3 principals, 4+ principals, or others? So you might be joining us from outside of the legal practice industry today. So just a couple more moments to register that. Thanks very much. So we've got basically the majority, 86% of our participants today being sole practitioners or in 2 to 3 principal firms, which make up about 90% of all legal firms in Australia, with the balance being in 4+ principal firms. The concepts that we're going to be going through today are exactly the same whether or not you're a sole practitioner with 1, 2 or 3 fee earners, or whether or not you're a 20 principal firm that's got a team of 200. Exactly the same principles. Whereabouts are you located? So as I said, I look after clients from all over Australia. So just getting a little bit of a feel for who's attending today. So we look like we've got a pretty strong presence from Queensland and New South Wales, with a smaller number from Victoria. So thanks for that. That's just some really good feedback that I can now pass on to my marketing team. And lastly, our last little bit of information, and then we'll get into it. So what best describes you? Are you a principal, an employed solicitor, or other? So a practice manager, or or somebody that's even outside of the legal industry. Okay, so thanks very much. 2/3 of our participants today are principals, with a small percentage of employed solicitors and 7% being others. So I'm thinking that the other 20% will most likely be the practice managers of firms. So with the majority being principals or practice managers or CEOs or general managers, the idea of what we're going to be focusing on today is to equip you with some knowledge, and it's probably knowledge that you already know, but to equip you with some knowledge and actions around what you need to do to be driving improvements in your profitability. I see what I'm going to run through today is what I've seen in legal firms consistently right throughout Australia, right throughout the varying sizes of firms. We have the exact consistent trend in nearly every single firm that I look at, and it's to do with the relationship between the revenue they generate and the profitability. And what it basically comes back to in most firms is that they have this disconnect between how they do the work and then how they generate the revenue from that work, which ultimately drives the profitability of the firm. And then there's a further disconnect, which we will cover off in the next webinar next month, on what happens about getting paid and driving improvements in cash flow. So this might seem pretty basic, but it's amazing that there are so many firms out there that don't get this. There are only 3 ways that you can increase your profitability. First of all, you've got to increase your revenue. Makes sense? Second of all, you've got to reduce your costs. The third way of increasing your profit is to do a mixture of both. Now, when I see firms, when they look at these, when they look at each of these areas, they aren't being specific, and they're not really focused in terms of identifying those key and critical activities that they need to implement. So around increased revenue, they might just focus on, oh, we've got to get our chargeable hours up. We've got to get people with higher levels of productivity. You know, we're not really focusing on our write-offs. They don't necessarily focus on the real drivers of profit, which is around how do we increase our number of matters and how do we increase our average matter value. When they look at costs, often the cost reduction strategies are based on overheads. Can we get our phones a bit cheaper? Can we get some cheaper advertising? Can we, what's our rent expenses? Are we buying Tim Tams or are we buying ginger nuts? Their focus is on the overhead cost structure of the business, where the biggest cost of most firms, of every firm, is in their direct labour costs. We're going to go through a bit of that. But where most of the profit improvement happens in firms is by focusing on a mixture of both. So really looking at how can we increase our revenues? What are those core things that we need to do about increasing our revenues? How do we reduce our costs? But how do we improve the relationship between our direct labour costs and the amount of revenue we get from it? So in your firm, what do you think? You can pick more than one of these, but what do you think the main reason is for a profit pressure that happens within your firm? Is it that you don't have enough revenue? Is it too many employees? Or are your overheads too high? Or is it a mixture of both or all of these? In some instances, that might be right. But the answer that I'm seeing here, we'll just have a couple more seconds to finalise this voting, is what I normally see in firms. So just last chance, I'll just close that off, share those results. But it's about not enough revenue. And most firms look at that and say, look, we're just not generating enough revenue. But often that not enough revenue comes from multiple different reasons. One of them might be is that they're not getting the right numbers of inquiry. Two might be that they're just too busy, and they're so busy doing other stuff that they're not, completing their files and matters off as quickly as what they should be. And it might be that out of their employees, everyone's busy, but we're not actually trapping enough time. It'd be about 90 to 95% of firms that I review and I work with are time-based billers. So they work on the basis where they're charging time. There'll be a mixture still of, okay, we've got some fixed fee conveyancing, or we might have fixed fee wills that we prepare, but mostly revenue is generated by time being charged. And even with fixed fee work, it's still going to come down to how much, what's the cost of our labour for that fixed fee revenue we generate. So I see this a lot. I see, okay, we've got not enough revenue that's being generated in our business, but often it's that relationship between the amount of our labour cost, that's what I call our direct labour cost, and our revenue that's created from that. So this is what I see in firms. First thing I see is a gross profit in firms of 50 to 60%. Now I'll come back in a moment on the next slide, and I'll explain to you in a bit more detail about what gross profit is. But fundamentally, it's that relationship between the revenue minus your direct labour cost. So this is the key number that we need to be measuring and focusing in our firms. And once firms start measuring their gross profit, and then they start focusing on the activities to drive improvements in this gross profit by looking at the key drivers of their revenue, that's when they can start changing the improvements. I see significant variations in gross profit based on areas of law. So the last few years, I've noticed predominantly in firms that there's a shift from PI being the big cash cows or the big dollar spinners in the legal industry, now moving more and more to family law, so where we have firms that have got multiple different areas of law, I see that these key ratios that drive gross profit vary significantly. But what firms tend to do is they tend to look at the profitability of the firm as a whole instead of drilling down into these different areas and identifying what are the different actions that we've got to be implementing in the different areas to drive consistent profitability. Because the different areas of law require different skills, different direct labour mixes, and so on. I always see this in firms. It's very rare in firms that I see the right ratio between productivity of principals and productivities of non-principal fee earners. Usually what I see in firms is high principal productivity and low other fee earners, non-principal productivity. And that's usually because the principals are head down, rear up, focusing on generating the revenue so that they can make sure they keep paying the bills, including the labour of these low fee earner employees that they know they've got to have, but they're just not generating the output that they need to be generating. So I often see principals of firms charging greater than 60% of their available hours, the time that's available in a day I'm doing client work. So greater than 60% is greater than 4.5 hours a day. So I often see principals focusing on trying to build out 6.5 hours in a day. I then see solicitors in firms often generating less than 50% of their own productive time, which is less than 3.8 charged hours in a day. So the hours that I work on is a 7.6 hour day, which is a 38-hour week. And so often there's this disconnect between principals and solicitors, where solicitors aren't generating enough productive time. And then I see legal support staff generating less than 25% or less than 1.9 hours a day of productive time that's ultimately getting billed and generated as turning into revenue. And when you look at the mathematics that you use in a time billing environment to determine your revenue, productivity is a key number. It's your number of full-time equivalent fee earners multiplied by the number of available hours, so the hours that they're there to work, multiplied by the percentage productivity, the percentage of that time that is actually charged into WIP, multiplied by the percentage of that time that's charged into WIP that you actually bill out. And then after it's billed, how much of that you recover. So where you've got the fundamental driver of revenue in a time-based billing model being the productivity of the fee earners, where you've got the greater number of solicitors and legal support staff achieving lower productivity numbers, then you are not going to get the leverage, and that is usually the main driver of poor profitability within firms. Then you lead on to the recovery of it. And that's, as I've got up here, the next point. So once the time even gets into WIP, I then see that being written off. So, if we're going to, first of all, driving improvement in revenue, we've got to fix productivity. But then we've got to recover it. We've got to focus on what are those activities we've got to do to bill out everything that goes into WIP. So how many employees do we have? How productive are they being? How much are we billing out of WIP? I see that legal support staff are not being charged to clients. I'm seeing more and more in firms these days. The ratio is changing between legal support staff to solicitors. I'm seeing that the ratio of a legal support person to a solicitor of 1-to-1 is quickly becoming out of date. Firms cannot afford to have that ratio anymore unless that legal support person is recovering a significant amount of their hours in revenue being charged to clients. So, I still sometimes see these firms that might have one or two principals, 2 or 3 solicitors, but are having 7 or 8 legal support staff. That by itself just drives incredible pressure on their profitability. So legal support staff not being charged to client is another big one. And then I see an indiscriminate use of time costing. I said before, it's the mathematics that drives your revenue. If you're a time billing business, it's your number of people times the number of hours they're there at work times the number of hours they charge to clients. So that productivity percentage multiplied by their charge rate, multiplied by their recovery rate, how much of that WIP they're billing. So if you've got a revenue formula that is actually based on time being charged into WIP, but time costing is used in an indiscriminate way, you are not going to be able to get a predictable outcome of your revenue. So you've got to go right back to the basics and get those structures right. You've got to have policy around what gets charged into WIP and what doesn't. Take away the discretion of people as to whether they can or can't put time into WIP at the time of entering the timesheets. If it doesn't go into WIP, it'll never get billed. But if it's in WIP, you can always write it off and not charge it. So I see this so often in firms. So the main pressure on profit is simply this: too much direct labour for the revenue earned. Now that doesn't mean that you go out and sack people. What it means is that you have got your relationship between the amount of revenue you generate and the amount of labour that you employ. So direct labour is not your receptionist and your practice manager. Direct labour is fee earners. So it's this relationship between too much labour for the revenue earned. Sorry, I mentioned before I was going to go to the next slide on gross profit, but here it is now. So let's have a look at what gross profit is, and let's look at what that relationship is. And then what I'm going to do is I'm going to work through some numbers with you on this pretty soon to show you how significant an impact getting this ratio wrong has on your profitability. So gross profit. You have all this revenue that you generate. Then what comes out of that revenue at the first line is your direct labour cost. So that's your labour cost for all of your fee earners. So it's your solicitors, it's your paralegals, it's your legal secretaries, but it excludes principals. And I take principals out of there because principals have a whole pile of other things they do in their firm. So I'm looking here at that labour cost where those employees, their predominant job and the only reason they're employed is to be doing client work. So that is basically the input cost around how we generate our revenue. So if you were, let's say you were a computer manufacturer, you've got many different inputs. So you've got the labour cost as an input, you've got plastics as an input, you've got glass as an input, you've got copper wiring as inputs, you've got all the electronic components as an input cost. All of these different costs that go in directly to producing that laptop that you then go and sell. For a legal firm, it's labour, and it's nothing more than labour. Yeah, you'll have some outlays that you recover, disbursements and so on. Yeah, you've got these overheads. But basically, your only cost that goes into producing your revenue is labour. And what I see in firms that are very successful, profitability-wise, I see that their gross profit, so their revenue minus their direct labour, runs at about 75% plus. Where I've got sole practitioner firms where there is a significant amount of revenue that's generated by the sole practitioner, those firms need to be targeting at least an 80% GP. So what that means is for a sole practitioner, you've got to be looking at only having 20% of your revenue as a direct labour cost. For non-sole practitioner firms, it's a little bit different because the leverage is a bit different. But basically, you've got to be looking at your total labour cost and getting at least 4 times the amount of that labour cost as revenue. I go into firms and they ask me about the old rule of thumb, 1/3, 1/3, 1/3. Absolute pile of rubbish. There's no rule that says that that's what it should be. And actually, the firms that focus on a 3 times multiple of labour in revenue generally are those firms that get their gross profits at 50 to 60% because of the variables that are produced in all of those with that labour cost, in terms of generating revenue. People being sick, people not charging it into their time into WIP, people riding off time, and so on. So gross profit is the key here, guys. We've really got to be focusing on that relationship between direct labour and gross and revenue. If you can fix that and you can get these ratios right to at least 75% plus, profitability will not be an issue for you. I see that in most firms, after they've been working with me for about a year or so, I see at least an improvement in their profitability that shows that they're often leaving, say, 20% of their revenue on the table in terms of either not recording time into WIP or not billing out what goes into WIP. I also see from an engagement perspective that their debtors improve simply because they engage their clients better. But it's around having key strategies and actions that drive those fundamental relationships between revenue and your direct labour cost that drives profit improvement. It's really your only variable. So what I do with firms is I get them to I go and assess what I call their efficiency factor. I have a look at what is their actual revenue that they generate compared to their capacity revenue. So their capacity revenue basically is, if it's in a perfect world and we've got this number of fee earners and they all hit their daily charged hours targets, and then at the right charge rate, all of that revenue is added into WIP, and then 100% of that revenue is billed to clients. That is what their capacity revenue is. So the goal is in your firm is to get your actual revenue as close as you can to your capacity revenue. The closer you can get it, the greater the gross profit, because what it means is each of those key variables in how you calculate your revenue is getting closer and closer to what it needs to be to achieve your budget. So if we look at an efficiency factor is basically the percentage of actual revenue to capacity revenue, this is what I see. I see firms that have got their revenue being more, their actual revenue being more than their capacity revenue. Look, they're very efficient. Now, when I'm talking about efficiency here, I'm not talking about how quickly they get a file done or how quickly they type. What I'm talking about here is the efficient use of the number of hours that they are paying their direct labour team to produce work. So that if they're producing greater than 100%, which I very rarely ever see this, by the way, it means they're very efficient, but they've got no capacity for growth because everyone's just banging out their hours. Firms that are doing about 90 to 100%, so their actual revenue is about 90% to 100% of their capacity revenue. Those firms are very efficient, but again, they have limited growth. So firms like to think, well, we've got to get everyone being productive, we've got to get them right up to budget. But as soon as people start getting within about a 4 to 5% percentage points of their target, they're efficient. They're getting pretty close to running it at full steam. Firms that are in the 75 to 90%, there are efficiency gains to be made. So if they're if they're lower at the 75%, there's efficiency gains to be made. If they're closer to 90%, there's not a great deal of efficiency gains to be made. If they're down at the lower end of that tranche, then there may be a need to reduce some labour cost. But generally, I find where firms are working in that 75 to 90%, there is a reasonable connection between their labour cost and their revenue. And it's only slight variations that they make, but those slight variations can make a significant impact. Where firms are less than 75%, look, they've got really inefficient use of their labour costs, and they generally need to reduce their fee earner labour costs. There's a whole pile of things also that they'll need to do about driving their revenue upwards, but I usually find that with those firms, the quickest gains can be made by reducing some of their cost and then working on driving revenue growth and better efficiency and improvement out of that labour that they're left with. So at this point, just another very quick poll. What do you think your efficiency factor is? Now, remembering it's basically what your actual revenue is divided by your capacity revenue. If I was doing this to to accountants, they'd all have their calculators out, but with lawyers, you're pretty good at running off your gut instincts here, so just go with that. And once again, it's just thinking about it from the perspective of how many people do I have and how much revenue should I be generating if everyone was fully occupied and charging and recovering their time versus what I am. So just a couple more seconds for those of you who haven't voted, and we'll close that poll off. So what we're seeing here is the majority of firms, so 91% of those listening in today, are less than 90%, with half being less than 75%. So it'd be interesting to go a little bit deeper into that half that are less than 75%. And I would anticipate that your numbers will most likely be within that 50 to 60% bracket. For those of you in the 75 to 90%, no doubt I'll have a bunch of optimists in there that will be thinking that that's where you are, but when you actually run the numbers, you're most likely to be at the lower end of that 75%, if not into the less than 75%. So for all of you, who are the majority of you, and those who are at 90 to 100%, when you're at that ratio, don't be afraid to increase your capacity. Don't be afraid to put more people on, provided you've got your systems right for driving that revenue growth, because you've got plenty of extra work for them to do. Usually do that via some extra delegation. So everybody that's here today, I think, in the main, whole chunk of work to be done. And it's pretty straightforward. Basically, what you do within your firms is you're focusing day to day on getting the work done. And you're head down, rear up doing that. What you need to be focusing on also is then getting your leverage from your team to make sure they're hitting their targets and implementing structured, focused processes, particularly around accountability and management of expectations to help you drive that. So let's now just have a look at some numbers. So what you'll see in front of you on the screen now is a calculation for fee earner capacity, okay? And this calculation basically just works on an individual by individual basis. It's a firm that's got a single principal. It's got 1.8 full-time equivalent solicitors and 1.6 full-time equivalent paralegals. They have a daily hours target within each of them that focuses them on how much time they need to be charging into WIP. They've got some charge rates there that you know are from a principal's perspective is quite low, but I often see. Their available hours. Now, their available hours are basically the hours that they're there working in a year. So you basically, the way you work that out is you take 52 weeks of the year, take off 4 weeks annual leave, 2 weeks sick leave, 2 weeks public holidays, which leaves you 44 weeks in the year at 5 days a week by 7.6 hours a day, or a 38-hour week gives you 1,672 hours. So that's the hours that people are there that are actually available there to do client work. So when you multiply all of that out, it gives 4,690 charged hours into WIP out of the 7,357, so that's at a 64% productivity, and the value of time charged is $1.12 million. That value of time charged there is your capacity. So if everything worked, if everyone hit their hours target and recovered 100% of the time that went into WIP, then you'd have $1.126 million of revenue that you'd generate. So I'm going to take that and I'm now going to compare that capacity to an example of actual revenue. So this is how we work out the efficiency factor. So in this firm, this is the actual revenue that they've generated. So they had 4.4 full-time equivalents with that same number of available hours. Their productivity for this firm, though, was only 51.22%. So on average across the firm, there was a low productivity that was being achieved. And their average charge rate was $242. Now, if I go in and I put in that capacity just based on this data, you know, we've got 4.4 full-time equivalents. Our productivity at capacity was 73.76%. So what that means is that for the same number of people, there's 923 less hours that are being charged into WIP than what is possible to charge into WIP. And interestingly, in this scenario, there was 240 average charge rate that was being charged instead of 242. So that's just the combination of all the amount of time that was actually charged into WIP. What this firm also then did is out of the time that was being charged into WIP at that charge rate of 242, they were still also writing off 11% of that time. So this is, first of all, not just not having enough time charged into WIP. Now, everyone in this firm would have been busy, but they're not landing their time into work in progress. But then what's going in there, they're writing off another 11%. Even though they would have engaged, hopefully, the client saying, this is how we're going to charge you, this is what the different charge out rates will be, this is an estimate of what we're going to be doing. So in this firm, they had $811,000 worth of revenue. They had a labour cost of $287,000 for those 2 solicitors and 1.8 solicitors and 1.6 full-time equivalent paralegals. And so that produces a gross profit of $524,000. $65,000, which then is a 65% GP, 65% gross profit. If they were hitting capacity, and we've got that exact same labour cost, then our gross profit at capacity is 74%. So with all of the components that build up the revenue in this firm, being how many people, how many hours are we charging into WIP, what average rate, and how much we recover, there's a shortfall of $314,000 of revenue that's just not landing into their profit and loss account. We've got the same rate labour cost, so we've got a much lower GP than what we could have. The efficiency factor in this firm is running therefore at 72%. What that means is that the revenue, actual revenue, is only 72% of capacity. If we could get that, say, up to 85%, then that's going to be another 13% of that $1.125 million, which off the top of my head is probably about $160,000 worth of gross profit that would land in there. So we don't have to go and land at 100%. It's unreal. But if we were able to just get a 10%, say, improvement in our efficiency factor, it's going to drive, or 12, 13%, it's going to drive $120,000 to $160,000 worth of extra gross profit just out of the work that we're doing. So another very important number to notice here is this number I've got there called average rate. And that average rate is the amount of revenue divided by the available hours. So whether the clients are working, whether the employees are charging work to clients or not, you still got to pay them for all the work that the time that they're there at work. Actually, you got to pay them for more than that. You got to pay them for those eight weeks that they're probably not going to be there as well. So your average rate is calculated by dividing your actual revenue divided by the number of hours, available hours, the hours that people are there at work. So by getting improvements in your productivity, in your recovery rates, in your average charge rates, your charge rates might not be right, what you get is better and greater improvement in this average rate. So average rate, apart from GP, is the key number that you need to be measuring within your firm. Okay, so I'll just close that down. So let's just take that another step further. So what we've got is across the firm, this is some different numbers. They are tying back to those numbers I just had. So this looks at those different areas of law. So looking at these numbers, what you've got is you've got a practice here that's got a number of areas of law. Those different areas of law produce different revenues. They also have got different labour costs in there, excluding principals. So they therefore produce different gross profits. What most firms do, if they even look at gross profit, they would look at that firm total on the right-hand side, which says they're making 63%. Right, well, okay, across the board we're making 63%. Let's work out what we've got to do. What you've got to do is you've got to go and break that down by each area of law so that you can assess what's actually happening. Now, in this particular firm, they had a view that family law was the bee's knees, that family law was producing a significantly higher amount of profitability than the rest of the firm. Interestingly enough, that wasn't the case. The gross profit that was being generated was only 54% compared to the commercial and the estates. So on a percentage-wise, it was, apart from conveyancing, it was the lowest gross profit generator. It was the second highest gross profit dollar generator, just following in behind estates. But with the commercial and conveyancing, not too far behind. But what it required, say, compared to estates, is an incredibly higher amount of labour 410 versus 95, 5.8 versus 1.2. So when you break all this down, it allows you then to look at, well, what's happening in each area of law? What should we be getting? Should we be making 75% gross profit out of this $900,000 in family? If we've got to get an extra 21%, what are the actions we've got to do to drive this average revenue per hour up? We can drive that average revenue per hour up to get these ratios right. It's not going to cost us anything more in labour. It's not going to cost us anything more in overhead. In fact, we might even have to reduce our labour. Or are we not generating and billing out enough revenue for what we should be for the work that we're doing? So you've got to get into the numbers, guys. As an accountant, it's the first place I look at is I go to the numbers, they tell me a story, I get to compare them against all these other firms that I look at. You know, I'd be looking at numbers at least every week, at least 2 different firms' numbers that are non-clients of mine, just to look at how they're going and what they're doing. But fundamentally, it all comes down to the same thing. What's that relationship between direct labour cost and the revenue that's being generated? What are the processes in that business that aren't supporting the mathematical formula for producing revenue? What are the activities we've got to do to improve our efficiency factor? What are the activities that we've got to do to get our profitability now? Increase revenue, reduce labour cost, or a mixture of both? So, actions to fix your profit. This is what you've got to do. First thing you've got to work on is the right ratio of fee earners to your average rate. So you work out the maths. So look at the maths and say, well, what is the result that I want to get? You know, so that's your capacity. Look at, if our capacity revenue is $1.2 million, we're currently running at $800,000, I want to get to $1 million. So let's look at the maths that is actually producing that. What have we got to change? What have we got to tweak? What have we got to look at in terms of our different areas of law, different strategies, different outcomes? So all of that drives an improvement and an increase in your average rate. You may need to reduce your fee earner numbers, but the key is to work out the maths, identify the issues, implement actions to get a different result. You need to improve productivity. So fundamentally, you've got to get your people doing work and billing that work to clients. As I said, predominantly firms are predominantly time billing firms. So align your expectations with your fee earners around what they need to be doing. You know, this is a business, it's not a charity. You know, they're there to perform. So you need to get that alignment. 100% of time costing. So if you do your time billing, time costing, 100% of people need to do it, including principals. Even if you are doing fixed fee work, you still need to time record, because you won't have a clue how efficient you've been or how profitable that particular matter is. And you need to do weekly reporting. You need to be giving weekly reporting to your team members so that they know where they're at, actual versus budget. You ought to be focusing on improving your recovery. So what goes into WIP gets billed. Set it as a rule. That second point there. Bill it if it's in WIP. Just bill it. The key to improving all of these is better client engagement. So particularly around recovery. The better you engage your clients at the front end, the better the client is aware of what you're going to be doing for them and how much it's likely to cost them, the easier it is to bill them and recover. Spend time at your engagement. We'll spend a whole bunch of time in my next webinar on looking at better client engagement, because it's also the key to cash flow. And systemize things. Get your systems in place for your major processes. And if that's systemization around billing, then turn your billing into an administration function. Get it away from the authors, because they're predominantly the worst billers going around. So if you want to do something different to get a different result, make sure you start and do that now. Sorry guys, I just sort of lost my place there. So So one last poll just before I wrap up. So how interested are you in obtaining a free efficiency assessment of your firm? So just jot that down and let me know. Um, so thanks for that. Just a couple more seconds just to register some interest there. Fantastic. So I'll just close that off. I've got some very good interest. What's going on? Technology comes and gets us every time. So what I'd like to offer to everyone participating today, for the first 5 people to email me at matt@fwo.net.au, I'll organise for a free 45-minute online meeting with you. Basically, what I'm just going to need is some of that data that we've gone through today. So, what's the makeup of your fee earners? What's their labour cost? We'll look at determining what the capacity is of your firm, and what we'll then do is we'll have a look at what that is compared to your actual revenue, and talk about what's happening in your firm around those actions to drive improvements in profitability. So just email me and we'll be in touch to schedule that in. Just a reminder, our next Grow Your Law Firm webinar is on Tuesday the 13th of October, 12 noon Eastern Standard Time. So on Queensland time, I'm in Brisbane. I'm not sure when daylight saving starts. I just wish it would start up here sometime, but I'm not sure when daylight saving starts. So it's 12 noon Eastern Standard Time, and it's all around cash flow. So what we're going to do is we're going to build on what we've done today. We're going to focus then on what have we got to do to get that cash flow coming in faster. How do we get our WIP build faster? How do we get our debtors collected faster? What have we got to do? And the key to that is how you engage your clients at the front end. So you can register for that now. We'll be sending out reminders to everybody closer to the time. But if you want to, you can just go onto my website at financiallywellorganised.com. On the email information you received in relation to this webinar, you can just click on the link there and register for those following webinars if you like. So look, thank you very much to everybody for your participation today. I do want to leave you with Einstein's definition of insanity. His definition of insanity is doing the same thing over and over again and expecting a different result. So please go back to the drawing board, work out your maths, look at what your capacity revenue is, look at what's happening in terms of your results, and then develop an action plan to drive some changes. You'll find that small changes in those key variables we went through today around productivity, around write-offs, and around average rate, small changes in those outcomes across the leverage team has significant impact on your profitability. So only got to make small changes to get a big outcome. So thank you very much. As always, if there's anything you'd like to run by me, please give me a call, drop me an email. All of our clients have unlimited telephone calls, emails, and meetings as required. So I extend that invitation to you. Anything you want to run by me, just give us a call. Thank you very much, and we'll see you next month.